Hey guys, it's your boy Justin here again with another news update. I've been seeing a lot of red days in the market lately, so I just wanted to give you guys an update on what I'm doing and what I'm thinking as far as the volatility. So again, this is nothing compared to what we all experienced in March. If you were in the market, if you weren't in the market, God bless you. I wish I was you, because those were definitely trying times. So even myself, I've been investing for 5 years. Definitely made some trades that I'm not proud of from March, but we all learn from our mistakes. And for the past 2 or 3 years, in one account, I'm up 3,000% or something, even after these past few days of crazy red days. So yeah, it is what it is. So today, the biggest issue about the last couple of days has been the bond yield. So it's not geopolitical, it's just the bond yield. So when the bond rates go up, big money tries to get out of riskier assets like regular stocks and tries to go into treasury yields because those are guaranteed returns. So when the yield starts to get up closer to 2%, those big funds are always going to try and look for at least a little diversification. Now, when the yield was getting closer to 1%, as it was before, it's really not even worth putting money into. So a lot of funds get out of it completely and just try to look for safer stocks. But with these bond yields rising and rising rapidly, really, it is like something to be a little bit worried about. But it's nothing to say that you should get rid of your entire portfolio. I have sold literally nothing. I sold, I sold a couple call options because I found opportunities elsewhere that I thought would be better. But I was up, hundreds of percent on those call options. So it wasn't like, it was really just trading one opportunity that I feel like might fizzle out, and for another one that I think will be really good for the future. So to explain to you guys what the bond yield issue is that a lot of these institutions have a certain threshold with their algorithms that they have running on these trading computers all day long. And once the bond yield reaches a certain amount, probably 1.6%, 1.5%, whatever it was, all of these institutions begin to just sell off on certain riskier assets and buy treasury bonds. So their whole job is to make sure that the people that are invested in their funds, get a certain return. So by switching out some of their investments into that 1.5, 1.6%, whatever the bond yield is at right now, it seems like a low rate, and it is. But older investors are looking at rates or looking at returns of like 8 to 12%, and they're like, okay, that's pretty good. So if you're looking at 8 to 12% as a total return, if you have, like, let's say 5 to 10% of your portfolio in bonds, that's a guaranteed 1.6%. So then they just got to make up the rest with riskier assets. You see what I'm saying? Like, that's where the thought process is coming from, as far as getting out of these riskier assets and selling them off, especially when they're at record highs. I mean, Apple stock was at near record highs. Tesla stock was at near record highs. I mean, a lot of these stocks are stocks that these funds have made 50 to 400% on. They're not going to stay in them forever. They're going to trade in and out of them. They know the game better than you and I. They have all the information that you and I do not have. They have Bloomberg terminals that cost thousands of dollars a month. They're not playing with the information that you and I have. But I can tell you what's publicly known, and this is what happens in every cycle, is that they go from the riskier assets to the less risky assets. So that means going from the Tesla stocks, the Apple stocks, the tech stocks that have outperformed the market dramatically, and then going to safer assets like Home Depot, the tech sector, anything in the industrials, anything in the travel industry, because those are going to rebound like crazy. So then they go into the treasury bonds because they're a little bit safer assets, or quite a bit safer assets. So then these funds have like large sell orders. That creates panic in the market because people are noticing that the sell orders are giant volumes. So that makes people even more scared. And then their stop loss orders get triggered. And a stop loss order is literally just a way to make sure that you don't lose your ass on an investment. So if you have a stop loss order set, then you can't lose beyond a certain amount. So if you bought Beyond Meat at $90 a share, and it's now 150, and you have a stop loss order for 140, once it hits 140, you're automatically going to sell, however many shares you told it to sell. That creates a problem because then once it hits 140, not only you did that, there were a bunch of other investors that did that more than likely, a bunch of firms that did that more than likely. So then it just creates like a domino effect, and then before you know it, you have a situation where, Beyond Meat or whatever stock it is at the time is falling dramatically, and it's not for any real reason. It's falling because a bunch of people put in orders to make sure that they lock in their profits, and then they'll buy back in when they feel it's appropriate. So I don't want everybody out there to get scared. This is a time to be smart and to buy more. If you're really confident in a company, I've bought more Tesla, I've bought Square stock. This is the time to take some cash and put it to work, because you will not regret it more than likely in a year or two. Again, this is not financial advice. I'm not a financial advisor. However, I've played this game for 5 years. I know how this goes. There's always some sort of panic. If you were in the market for the December 2018 bloodbath, trust me, you know what it's like. That made this week seem like nothing. That back then, like, every stock was just getting destroyed. It was just an awful time. It was awful. I remember even Christmas Eve was like a half day of trading, or the day before Christmas Eve, one or the other. And it was just so bloody. I was like, God, this is gonna ruin my Christmas. I'm like, this is just depressing, but you always get over it. It's always, you can't think short term. The biggest thing that if you learn anything from this video, or any of my videos for that matter, is that you can't think short term. You have to think long term about anything in life, really. You're not gonna go and get a 4-year, or go to school for a 4-year degree and quit after 6 months. You knew it was going to take 4 years. You could shorten it to 2 or 3, possibly, if you take a lot of credits each semester. But you're not going to get out of there in 3 months and get a 4-year degree. That's just not how it works. You got to put in the time, just like everybody else. And investing is the same way. You got to take your time, you got to research the stock, and you got to really believe in the company and understand that just because it went down today doesn't mean it's going to keep going down. And that it's not going to be a much higher value and a much higher stock price in 2 years and 3 years and 4 years, even 6 months from today. Just hold on. It's always scary before it gets good, and you can't have those good days without some of these scary days, unfortunately. You should always be diversifying your portfolio in about like 7 to 10 stocks. I hold, I think like 15 stocks or something. I'll pull up my M1 portfolio one of these days when I can figure out how to change it to my iPad screen or my laptop screen, and I'll give you guys an idea of what I'm investing in. I'm pretty diversified on that portfolio. A lot of my wealth right now is in riskier assets like derivatives, but I will be transitioning most of that away as those derivatives get closer to expiration. Into common stock, into ETFs, into dividend stocks. But I'm going to keep probably 70 to 80% of my wealth that's invested in riskier growth stocks that I believe in, because I'm 28. I work 7 days a week. I'm a social worker and a server, and sometimes I work to a third or fourth job on top of that. I have no worry about me making enough money to pay my bills. I just want to try and get to hopefully 8 figures of wealth by the time I'm 40. So I'm 28 now. I'm going to be 29 in April, and I don't think that that's too lofty of a goal. So if you guys want to follow and watch me go and just see if I can hit even close to that within the next 5 to 10 years, like and subscribe and comment below if you have any questions or any comments to help the channel, any content that you'd like me to do. I'd be more than willing to take you up on it and do a video on specific stocks if you're interested in specific stocks, or just what makes me bullish on any specific stock in general. So take care, guys, and don't let all this craziness get to your head. Just like when anybody tells you anything crazy about your dreams or your goals, your aspirations, 99% of the time, they're just saying that because they don't think they can do it themselves. And I've met a lot of people over my entire life that they'll never take the risks that are associated with becoming wealthy or even remotely wealthy. So don't be like them. You don't want to have to work a job you don't like or whatever for the rest of your life just because you feel trapped. There is a way out, and there's a way to a better life. And if you let me, I can try and help you to get there. Take care, guys.